First off, thank you very much for joining us today, crossing the pond to be a part of our event and to support a really great cause. So very much appreciated.
Pleasure.
But let's dive right in. So I think most investors know Man Group today as one of the world's largest publicly traded hedge fund companies. But I understand the firm has a very long and interesting history dating back to the 1700s. And was actually a sugar brokerage. What can you tell us about sort of the interesting origins of the Man Group?
At the risk of following Anthony, but so we're actually the world's largest listed hedge fund business, and we're probably the third largest hedge fund business out there. So the firm actually started 240 years ago. So when I'm a little further south of the border, I tend to talk about ages of countries against ages of firms. But for 200 and something years of that, the firm was a sugar broker. And actually the real thing it made money out of was that they had a monopoly in providing rum to the Royal Navy. Now, most of you won't know, but basically in the Royal Navy for 200 and something years, everybody got about that much rum every day. And Man had the monopoly in supplying that. And every single member of the Royal Navy got it. You couldn't refuse it. In the 1930s was the first time anybody was allowed to refuse it, and that was on religious grounds. You had to have it every day, all the way up to the Admiral. So basically the Royal Navy, when it conquered the world, was drunk. And incredibly to me, remember when nuclear submarines came in, right? The point where they stopped that rum was 1971. So you had drunk people driving nuclear submarines.
Wow, fascinating. Now, I read somewhere that you knew you wanted to be into finance at the young age of 7. I think it said you started playing cards at the age of 3 and actually graduated onto the racetrack by the age of 5 and were betting on horses. So you were betting on the ponies before you learned how to ride a bike. What can you tell us about your upbringing and what's led you through your career and into your current position?
I think mostly you get people come up and talking these sorts of things, and they sort of say, oh, I fell into this. You know, I wanted to be a lawyer, or I wanted to be an author or something. As you say, I mean, I knew from a very early age, well, I wanted to be a bookie. Because I worked out this was quite a fun game, because my grandfather taught me to bet on the horses age 5 and to do it properly, read the form, did it. But I worked out the bookies were winning. You know, I guess I've always had a natural feeling for maths, for patterns of numbers, and I worked out the bookies were the ones winning. So I sort of said to my grandfather, could I do that? And he said, well, yeah, but maybe not on the racetrack. Maybe you should do it in the city. So I knew I wanted to do that. And I think I tried to add it up the other day. I don't know, we have probably 150 PhDs work for us nowadays. When I was at JP Morgan, I had 100 PhDs. I'm not remotely the best mathematician. I'm not in the top 200 or 300 mathematicians within the firm. But I can understand numbers and patterns. I have no musical ability, but when I see an orchestra, if somebody plays a note out of tune, I can see who did it and which one it was, not just because I missed the pattern. And I think financial markets are the most fascinating pattern environment you could find in anything, because they're unbelievably varied patterns. There are some things that rhyme and repeat, and many things which change all the time, and that's what makes this, to me, the most interesting opportunity you can get, really.
And in terms of your career, I understand there was a small hiatus that you took where you were actually a pig farmer, and you were on your hands and knees digging holes in the ground. What was that? And how does that, what are the commonalities that make you a good farmer and make you a good hedge fund manager?
So I built a business for a bank for 10 years, which was, I basically started their equity derivative business at JP Morgan and got it to making $1 billion, and then I left. And then I started a fund of funds business. So I had at one point a similar story to Anthony. We started with 50 million and we got to 15 billion, and I couldn't convince my partner to sell the business. And this was 2007, and I didn't know that the world was about to end, but I did know nobody was ever going to pay you quite that high a price for a fund of funds business. And when I couldn't convince him to buy me out, I decided I would retire because I was in the lucky place where my life was funded and my kids' life was funded. And as you said, so I don't know whether this would ever have been on. There was a TV program when I was young called The Good Life, which was about, so it was Felicity Kendall, if any of you know her. She's sort of always been my ideal woman. And she and her husband sort of turned a back garden of a suburban house into a farm and lived off it. And we sort of did that. Well, we were a bit lucky. We had 400 acres. So it was slightly less messy than the one in The Good Life. And basically, what's the similarity between that and everything else? I think you have to have a real passion for what you do. I stopped when I wasn't enjoying what I do. I came back to work because there's an opportunity. I had a really good time when I was retired for 2 or 3 years, and when I came back, it's because there's a really interesting thing to do that I can go at with absolute passion. If anybody wants to have a nerdy conversation about how you make meat or vegetables, but it was more about meat, taste better, and what you can do to make a difference, I could get incredibly nerdy about it. That was sort of the point about what we did with the farming, was not trying to make money out of it, but was all about doing controlled experiments to work out, well, if you fed the pigs like this, did they taste better? Did the breed matter? Did the way they died matter, et cetera, et cetera? Because I'm just a nerd, basically. You know, I was listening to Anthony's thing about culture, and I think that the one unifying bit of culture we have in man is the place is full of nerds, and that's both mathematical type of nerds, but nerds about pig farming or rugby or wine, or there's sort of no subject that you won't find somebody within man who is A, a super expert on, and B, would love to talk to you for at least 8 hours about it.
So over recent years, we've realized a fairly uniform appreciation in the price of risk assets during what's been probably the least volatile period, certainly in recent history. With such high degree of cross-asset correlation, low dispersion, I think it's fair to say that hedge fund returns have generally lagged expectations. Now, we do our best at Prime Quadrant to explain to our clients why hedge fund returns have been somewhat subdued, but also on why it shouldn't necessarily be the biggest concern, given everything else in their portfolio has been going up indiscriminately. With $100 billion in assets, you clearly are the expert in the room. What is your view on recent hedge fund performance, and are there any macro factors that you may think, may increase volatility, create some dispersion, some mispriced securities going forward?
I guess I'm going to start with a slightly big picture thought, which is you have to think about what it is you're trying to achieve. My guess is most people in the room are trying to achieve something that feels like a 4 or 5% real return. Most people globally end up trying to achieve something that feels like a 4 or 5% real return. If your objectives are to make 1 or 2% growth, then you shouldn't invest in hedge funds. You can now go and stick your money on deposit at JP Morgan and you're in a pretty good shape. If you're trying to make 4 or 5% real returns, which, let's call it 6, 7%, everybody can start with a beta portfolio. You start with a beta portfolio of bonds plus equities. We can debate weightings. It doesn't really matter. It certainly hasn't mattered, interestingly, for the last sort of 10 or 20 years, what the weighting between bonds and equities are. And you have to look at what the forward-looking returns are. In 2010, if you bought bonds or equities, you were buying them really cheap, and the forward-looking returns look very good, and they've been even better than anybody could have imagined. Today, if you buy simple bonds and simple equities, the forward-looking returns don't look very exciting. It's very hard to see any real return out of bonds if you buy them here. You're getting a sort of 2.5%, 3% yield in dollars against a 2.5%, 3% inflation expectation. If you were unlucky enough to be in the UK, you can have the pleasure of buying inflation-linked bonds from the UK government, who will remarkably sell them to you at 150 basis points below inflation. and they all get bought, which guarantees you're not going to make anything real there. From equities, given where valuations are, I mean, notwithstanding a few days of wobbles in October, but the reality from where growth expectations are today and where we are on valuations, you're sort of looking at a 3 or a 4% real return looking forward. And if you put those two things together, it doesn't get you what you're after. So then you have to do something to try to increase your return. If you think hedge funds are the way to try and make massive returns in normal markets, you're misunderstanding the point of them. You shouldn't pay a 20% performance fee for beta. I want to be very clear about it. You shouldn't pay a 20% performance fee for beta. You can get your betas for basically nothing. So hedge funds should be about providing you in some form a diversifying return, a differentiated return to the core portfolio. If the core portfolio is doing really well, your diversifying thing isn't supposed to do really well in that environment. You don't want it to be burning money. And actually, I think when you look at what hedge funds have done, look, it's not exciting, but they haven't burnt money, and they do let you own more risk in the rest of your portfolio. And then when this environment breaks, and it will break without any doubt, it's a question of when, it will break. The answer is you are going to need other things than being long equities, because that's going to feel very painful at some point.
So I imagine many of your strategies would benefit from a higher volatility environment. In October, we saw equities sell off 5 to 10%, depending on where credit spreads blew out a bit. The VIX went from 12 to 25. Oil sold off 10. Now, I'm not going to ask you to predict the market top, but are we starting to maybe shift from this low vol environment where everything is moving higher to an environment that may have volatilities levels more consistent with historical norms?
I think, people always like to use the baseball analogy. I mean, we are clearly in a later innings in the whole exercise. The confidence about economic growth globally is dropping. In terms of a big picture, honestly, I think that we are seeing a breakdown in the world order that we've had for the last 40 years. Now, this is a political thing, and I would say never invest in markets based on politics. But I think what you're seeing in the increased volatility is the fact that we've been through a period of incredible consensus between central bankers, who've all followed the lead of the Fed, and politicians who all followed the lead of the central bankers. For better or worse, Donald Trump has done exactly the opposite of that. And now you have the central bank and the government pulling in reasonably opposite directions. If you live within the US, what we could see is it's been good for asset prices in the US so far. If you live outside the US, as you know well here in Canada, he's not very discriminate on who he's been picking on. I don't think the WTO survives probably even another 2 years of Donald Trump. It certainly doesn't survive another 6 years of Donald Trump. It's very hard if you sit in Europe to think that NATO actually fulfills the function that it theoretically fulfills today, because, okay, look, if the Russians invaded the UK, I'm absolutely sure that America would come and defend us. If the Russians invade Estonia, is there anybody in the room that thinks that Donald Trump will recommend sending troops in? I don't think so. And so you're seeing a gradual breakdown in the world order, which was based around the fact that the dollar was the reserve currency in the world, and that the US Army was essentially the policeman of the world. If you believe that's happening, you are going to get a series of these pre-shocks before you get something which is a significant repricing. I don't know when it's going to happen. I think trying to judge when it's going to happen is always a dangerous game. But the financial markets are based on a premise that the Fed is there to look after everybody, and I don't think that's true anymore.
So more and more today, we're seeing computer or model-driven trading strategies, most prominent being quantitative equity, StatR, trend following CTAs. Man Group has really come to be a leader in the space in terms of implementing technology into your investment processes. How do you differentiate yourself in that regard while in search for outperformance and risk reduction?
So I guess there's everything we do in life, technology is taking a bigger and bigger part, right? It's amazing to think that it's less than 12 years ago that the first iPhone was produced, and now none of us, I would imagine that there's less than 0.1% of people in the room who don't have some form of smartphone in their pocket. I've got two sitting there, I've got two iPads sitting in a bag out there. It's hard to imagine living without that sort of technology. The same is true in investing. When I started, the way the Bank of England, I'm older than I look, the way the Bank of England used to tell people about changes in interest rates was we and a dozen other people employed a chap who at 11 o'clock every day would literally put a top hat on and walk round to the Bank of England for a glass of sherry. And during the course of the glass of sherry, the Bank of England would say, well, they thought rates could be a little bit higher, or they thought rates could be a little bit lower. He would come back. If you were lucky, he would tell people what they'd said. If you were unlucky, he went straight to lunch to drink 2 large gin and tonics and then wine and then port, because that was his sole job. But that's how the Bank of England told people about interest rate changes. Clearly today, it's a rather different world. The way you execute trades has changed incredibly. And through all of this, you can use technology to really differentiate the things you do. So we are very active traders across the firm. So, if we run 115 billion or whatever it is, that doesn't sound a particularly big number. If I told you our annual turnover is high single-digit trillions of dollars, you could see we trade a lot of things. We trade frequently and we trade across a lot of different markets looking for opportunity and ideas. We're not a high-frequency trader in the way of flash boys. We don't do any of that, but you can trade more and more instruments using computers. There are many things that if you try to execute trades with humans, you have no chance of competing today with computers. And we will trade everything from simple stocks all the way through to, we trade electricity. The price of electricity in this building is something we trade electronically. Some things you're doing where you're using technology to help a human be better at their job. I'm sure we all know the story about how you can't beat a chess game at chess. Computers are much better than humans now, but a human with a chess game can beat a chess game without a human. So we have a lot where we use technology to help the humans, but we also have a lot where we have, we are one of the biggest algorithmic investors in the world. So through equity market neutral, through CTAs and so on and so forth, all the way through to the cool, if rather scary stuff of machine learning where, you end up at the place where the algorithm is written by itself. And, I will say it's quite scary when you look at it, but they are really quite impressive, some of the things that they can achieve.
So when you look at the landscape of the top players in your space, right, you have the 2 Sigmas, the AQRs, the Renaissance, the Man Groups. I mean, how do the top tier players differentiate themselves from their competitors? I mean, you can all go to Stanford, MIT, Caltech. You can recruit the biggest and best PhDs.
Yeah,
from my perspective,
you can't.
I think
the big thing is, there is a thing about a research budget. You can't do this stuff. It's an arms race, and if you are running around with a sword or a bow and arrow, you're going to get obliterated. And if you turn up at Stanford saying, hey, I'd like to hire a clever person, they laugh at you, right? There is an amazing competitive process to try to get the best graduates, the best PhD students out of top universities. Yes, we compete against a Renaissance or a Two Sigma, but we compete against Facebook and Google and Walmart and whoever else is trying to hire the same sorts of talent. And it is, so when you get sort of natural discretionary firms turn up and try and hire a clever person to sit in the corner, the clever people know that they are inheriting the world, right? It used to be the meek will inherit the earth. Now it's the nerds will inherit the earth. And they know it, and they don't go to the first person that offers them a job. They want to understand that the culture for what they want to do is interesting and is something they embrace. So, while, in our discretionary portfolio managers, pretty much the day doesn't go by where someone doesn't come and try and argue with me for more money. In the quant parts of the business, they argue for, they wanted a 3D printer. We don't need a 3D printer for what we do at work, but they wanted a 3D printer because they wanted to experience how that would work. We built a room where you can go and build, effectively, it's got all the kit to build very top-end electronic cars, because they worked out that there's a quite an interesting machine learning game for how you would drive an electronic car around a room like this full of people, and that's and you have to embrace that type of thinking, which is really quite different than the, hey, I've got a big name and I'll pay you a big check. The second thing is, trying to not sound old as I say this, but there is a whole generational thing now where if you want to hire a very smart 25 to 30-year-old who's got great academic qualifications, the first thing they'll say is, I want to make a difference. Now, when I started work, the difference I made was I was the guy that got shouted at to go and buy the McDonald's at lunchtime, or whatever else it was. That was the junior trader's job, was you go off and get the lunch, and you go and do this, and you gradually. Now people want to make a difference really quickly. And one of the interesting things is, Google can pay much more money for these smart kids than I can. Right? I mean, it's a sort of striking thing in life that the people with the really big checkbooks are the tech companies. But if you go to Google, as you look at the numbers, it's the fact we still call it Google rather than Alphabet is the definition, right? All of the money and a whole load more is made out of search. All the rest of the stuff is sort of playthings on the side. And if you're a brilliant PhD with whatever, you turn up at Google age 30, if you're really lucky and you do a brilliant job, in 10 or 15 years, they might let you somewhere near the search engine. You don't get to make a difference when you get there. In financial markets, we can bring these kids, same age as my kids anyway, and you can give them basically the chance to go and build an algorithm, and we'll run money on it within a matter of 2 or 3 months of arriving in the firm. That is exciting if you want to have intellectual rewards, which is a millennial thing.
So let's talk man versus machine for a moment. You'll often hear investors refer to systematic trading as a quote-unquote black box, meaning they don't completely understand it, they don't know what is going into the decision-making, they feel a little bit in the dark. Now, for you, your PMs, your computer programmers, model-driven investing is perfectly clear, transparent, and understandable. And I once heard you say something that I thought was quite interesting, and that was, from your perspective, human beings are the black box. A model is predictable, but without getting too scientific, the chemical reactions that go on in the human brain when they're making a decision is truly the unknown. Can you elaborate on that?
Yeah, I'm going to get myself in trouble again here. So there's a couple of things that I've said on these sorts of conversations and got in trouble. I believe in discretionary investing. I believe in quantitative investing. I believe that computers will gradually take over functions from humans in every sphere of life over the next 10 or 20 years. And it's true in investing, it's true in lawyers, it's true in driving cars. And 20 years from now, I'm really not sure how many discretionary investors will be left in the world, to be honest. The bit that got me in trouble, so when you have a computer, when you have an algorithm, I can tell you exactly what it's going to do. If you tell me what happens to a market price today, tomorrow, the next day, I know exactly what it's going to do. I know why it's going to do it. It's very, very clear. I have been married for 29 years now. I love my wife very dearly. We have a very good marriage. When I call up to say, how was your day? I have no idea what reaction I'm going to get. And I'm sure she thinks the same thing when she talks to me. Humans are inherently complicated things where reactions are not clear. When you talk to a discretionary macro manager, honestly, you have no idea what they're going to do tomorrow. And so I think computerized systems of investing are transparent glass boxes, and humans are the black box. People worry, they think that, if I can sort of look somebody in the eye and judge them as a character, then I know how they're going to behave. There's an interesting book that's called, it's got a slightly strange title, it's something like the Before the Dog in the Night, or something like that, which is a guy that I knew from Goldman Sachs, who then went off and did a PhD in physiology. And it basically looks at the trading instincts, and one of the things that's really interesting physiologically is that when you talk about people reacting to market changes and making quick decisions, a lot of those they can prove never go to the brain. That a lot of decisions we make are not actually thought through decisions in the brain, but the vagus nerve, I think it's called, actually makes various decisions for us. The idea that we'd let not our brain make a decision sounds really scary to all of us, but your reactions cannot go from you seeing something to the motor neurons passing up to your brain, passing back to your finger to react to it. So it is, look, I am an evangelist. I'm a believer in using computerized systems. I think you can explain to people very clearly what they're going to do, why they're going to do it, and that dependability makes them much easier to put in your portfolio.
You touched on the growth of the space, and when we look 20, 30, 50 years out in the dominance of these computerized trading programs, what does that mean for market efficiency? I mean, if computers are so advanced in the future that they're incorporating all available information, we remove human error, we remove human emotion from the market. How do you have significantly mispriced securities, or do you?
I think when one starts to talk about what technology will do for us in 20 to 50 years' time, everything you end up talking about sounds like some sort of science fiction. And, I'm personally totally convinced that 20 years from now, the only cars operating in Toronto will be driverless cars. You won't be allowed to drive into Toronto. And that's quite hard to get your mind around. You won't own a car. You won't drive it. All of that will happen. And, for those of us who grew up in a generation where owning a car with a cool engine and a sports car was one of the sort of dream things to own, it's a bit weird to think of the idea that even 20 years from now, and it might be quicker, that they just won't exist in cities. There's a very good Bill Gates expression about how over a 1 or 2 year time horizon, we dramatically overestimate the amount that technology will change things. But over a 10-year time horizon, you cannot believe how much we underestimate what it will do. As I say, go back 12 years ago, the smartphone didn't exist, right? That thing didn't exist. And today, we're now So this one, I believe, is 10,000 times more powerful than all the technology that took man to the moon. So I guess there's that movie out at the moment about the first man on the moon, and you see they didn't have that much technology. But it is incredible what's in there, and 10 years from now, it's almost impossible. So I don't know what investing will look like in 20 years' time. I had to do a presentation to the board on that. And what I can talk about is the direction that's happening now, the things you can do today, and in 5 years' time, there's still going to be most people investing in a discretionary way, probably in 10 years' time. But in 20 years' time, they asked me how many people I thought would work for Man Group in 20 years' time. So there's 1,400 people work for us today. I said, look, I'm not sure, but I wouldn't bet against the number being 2. They thought I was a bit radical. I was like, well, my guess is you'll still have somebody who's called CEO, but it certainly won't be me. And you'll have somebody who pats them on the head and says, there, dear. And that's about it, I suspect.
Let's talk manager selection for a moment. As someone who's run very successful fund-to-fund businesses over the years, is there an ideal time in a fund's life cycle that you want to be invested as an allocator? Now, I'm probably asking you to generalize a bit, as the answer will differ based on strategy. Different strategies have different resource requirements and scalability. But I talked to a lot of hedge fund seeders, right? And there's a lot of data out there that suggests smaller, younger funds tend to outperform their larger, more established peers, right? And the justification being younger PMs are hungrier. They haven't made themselves wealthy yet. They're more entrepreneurial. There's also what I refer to as sort of size arbitrage, right? This notion of dollar alpha. Mm-hmm. What is your view on that, and when is the ideal time to be with a manager from your perspective?
So I think there are some clear things which you should avoid. So most managers get too big, and big is a problem. So you might think I'm a bit strange saying that when we run 100 and whatever billion, but the answer is we run 100 and whatever billion in 100 different products, because I don't believe, it would be much easier if we just had one massive fund, but I don't believe you can generate returns if you try to run too much money with a particular strategy. So I think too big is a bad thing. I think that when people are going through divorces is a disastrous thing. If there's one thing you should ask people about, it's the state of their marriage, because every single manager I know who's been through a divorce has been through a period of terrible performance. They all say it's not going to affect them. It does. I think personally that it's much better to invest in managers who've made a mistake and learned from it than people who haven't made a mistake. People always want to invest in the perfect-looking track record, and all the money tends to flock to the new manager that shows a track record that looks perfect, like it's never lost money. Everybody loses money at some point, right? Every single strategy will lose money at some point. And typically, honestly, the answer is 1 year in 4, a strategy loses money. If you find somebody who's really good, it's 1 year in 5, they lose money. The worst thing to do is to find the manager that's got 3 years of a perfect track record and assume that they're always going to have a perfect track record going forward. Because if you take that mass of 1 year in 4 or 1 year in 5, the chances that the next year is the 1 year in 4 or 5 is really quite high. And secondly, people who haven't had a difficult time, people who haven't been tested under fire when they're losing money and when their strategy doesn't work, they are the people who tend to do the wrong thing under that environment. You learn from making mistakes. That is what humans are all about. Anybody who's got kids knows the answer is you can't teach them how to be safe by giving them a whole load of instructions, right? They have to learn through experience of falling over and banging their knee or burning their hand or whatever it is. You want to try to stop them sticking their tongue in a plug. That's bad, right? But the people learn from making mistakes. That's how humans learn. So I think it's much better to invest in somebody that has been through a difficult period and come out rather than these sort of pretty perfect track records.
Right.
But big in an individual fund is a problem.
Institutional investors comprise, I believe, over 80% of Man's AUM today. Many of the individuals in the room have been fortunate enough to accumulate an institutional amount of capital. And to close out the conversation, what advice do you have for them in terms of how they should be thinking about their portfolios today?
So I guess two ways of thinking about that. One of them is, so I mean, as I talked about earlier, I have a belief in a big picture that we are headed to a significant change in environment, but that doesn't mean I think it's going to come tomorrow. I think that far too often people sit on these sorts of stages and tell you about how tomorrow is going to be completely different than today. Now's the moment to get short. Now's the moment to do something radically different. I think that most of the time you want to own risk assets, but you do want to have a set of clear rules and processes for how you're going to get out and when you're going to get out. So it's absolutely fine to still be long US equities, but you should have a set of rules for how to get out, because if you're trying to make the decision when things are getting difficult, you will make a mess of that decision. You'll hold on too long. The second thing I'd say is there's a great difference between trading rules and rules you should apply to managers. So one of the things that I learned, so when you're a trader, you get taught this whole thing about cut your losers, run your winners. It's a golden rule of everything. Managers, if you invest with managers, if you do your investing directly in assets, you should follow that rule. If you invest in managers, it's different, right? Managers aren't assets. And the answer is, if you run your winners, you are increasing the size of the position, and you should definitely consider taking money off the table. And in a similar way, all of the worst investing decisions I've made in 20 years or whatever are where we sold a manager who went through a difficult period. We sold it, and then actually they came back, and you sort of, it's incredibly hard to go back to a manager you've sold. Patience is a very good virtue in there.
Great. This has been fascinating. I hope the audience has found it as interesting as I have. We really appreciate you being here. Luke, Ellis, ladies and gentlemen.
Thank you very much.
Okay. Thank you.
My pleasure.